Welcome back to Future Financial Freedom. Today, we're continuing our deep dive into the world of behavioral finance. In this episode, we'll explore how our minds impact our financial decisions and discover practical tips to enhance our investment strategies. Let's get started with Chapter 3 and 4 of our series. Chapter 3, The Behavioral Asset, focuses on the unique value of understanding and managing our psychological tendencies when investing. Think of your brain as your greatest financial asset. The way we think, feel, and react to financial situations can significantly influence our investment outcomes. Many investors focus solely on numbers and data, ignoring the human element, which is crucial. Let's dive into behavioral alpha. This term refers to the excess returns you can achieve by managing your own behavior better than the average investor. It's not just about picking the right stocks or timing the market. It's about being aware of and controlling your emotional and cognitive biases. Consider recency bias, our tendency to give undue weight to recent events. If a stock has been performing well lately, we might assume it will continue to do so indefinitely. However, this can lead to poor decision-making. For instance, during the tech boom of the late 1990s, investors poured money into tech stocks, believing the boom would never end. When the bubble burst, many suffered significant losses. Next, let's discuss status quo bias, our preference for things to stay the same, even if change might be beneficial. An investor might stick with an underperforming portfolio simply because it's familiar. This inertia can prevent us from making necessary adjustments to improve our financial health. Then there's herd mentality, our instinct to follow the crowd, often leading to suboptimal decisions. Remember the housing market crash in 2008? Many people bought homes at inflated prices because everyone else was doing it. When the bubble burst, it left many in financial ruin. How can we leverage this understanding of behavioral finance to our advantage? First, self-awareness is key. Recognize when you might be falling prey to these biases. Second, create and stick to a solid investment plan. Automation can help by taking emotions out of the equation. Finally, consider seeking advice from a financial advisor who can provide an objective perspective. To wrap up Chapter 3, remember that your behavior is one of your most valuable assets in investing. By understanding and managing your psychological tendencies, you can achieve better financial outcomes and truly harness the power of behavioral alpha. Moving on to Chapter 4, Behavioral Portfolio Management, we'll delve into how to apply these behavioral insights to build a robust and resilient investment portfolio. First, let's talk about diversification. It's a classic strategy, but many investors misunderstand its psychological benefits. Diversifying your investments not only spreads risk, but also helps manage emotional reactions. When one asset underperforms, another might excel, balancing your emotional responses. An excellent example is the combination of stocks and bonds. Stocks provide growth, while bonds offer stability. During market downturns, bonds can cushion the blow, helping you stay calm and stick to your long-term plan. Next, let's explore rebalancing, the practice of adjusting your portfolio back to its target allocation. This discipline forces you to buy low and sell high, countering the natural inclination to chase performance. Imagine having a portfolio that's 60% stocks and 40% bonds. After a strong year for stocks, your allocation might shift to 70% stocks and 30% bonds. Rebalancing would involve selling some stocks and buying bonds to restore your original allocation, promoting disciplined investing. Another key concept is risk tolerance. Assessing your risk tolerance isn't just about numbers. It's about understanding your psychological comfort with market volatility. Are you able to stay the course during market downturns? Or do you panic and sell at the worst possible time? A financial advisor can help you assess your true risk tolerance and build a portfolio that matches it. Additionally, goal-based investing can be a game changer. Instead of focusing solely on maximizing returns, align your investments with your personal financial goals. This approach adds meaning to your investments and can reduce the emotional roller coaster. For instance, if you're saving for a child's education, you'll have a different investment strategy than if you're saving for retirement. Finally, embrace behavioral coaching. Working with a financial advisor isn't just about picking investments. It's about having a coach who helps you stay disciplined, avoid emotional decisions, and stick to your plan. They can provide the objectivity and accountability that's often hard to maintain on your own. To sum up Chapter 4, applying behavioral insights to portfolio management involves diversification, rebalancing, assessing risk tolerance, goal-based investing, and behavioral coaching. By integrating these strategies, you can build a resilient portfolio that not only meets your financial goals, but also keeps you emotionally grounded. Thanks for joining us on this journey through behavioral finance. Before we go, I wanted to share a few resources that might help you in your investing journey. These are tools and books that I personally recommend for anyone looking to understand and master behavioral finance. Check out the links in the description below. They're fantastic bonuses to enhance your financial knowledge and strategies. Stay tuned for our next episode, where we'll explore more strategies to master your investments. Don't forget to like, comment, and subscribe to Future Financial Freedom for more insights into smart investing and financial planning. Until next time, invest wisely and stay curious.